The first check is the index or exposure being tracked. ETF names can sound similar while the underlying index, weighting rule, rebalancing schedule, geographic scope, sector exposure, and factor screen are different. One fund may track broad market beta. Another may track dividends, low volatility, growth, value, bonds, commodities, or a narrow theme. The question before buying is what it tracks. The question after buying is whether it still gives the exposure you intended. The second check is tracking difference and tracking error. An ETF's return does not always match its index perfectly. The gap can come from expense ratio, cash drag, replication method, trading costs, taxes, securities lending, currency effects, rebalancing, and market liquidity. A one-day difference is not automatically a problem. The review should ask whether the gap is persistent, explainable, and reasonable for the fund design. The third check is total cost. Many investors only look at the headline expense ratio, but the real cost of ownership includes internal fund costs, bid-ask spreads, premiums and discounts, brokerage costs, foreign exchange, tax drag, and reinvestment friction. Low cost is usually a major advantage, but cost must be compared with the exposure actually needed. A cheap ETF that serves the wrong role can still be an expensive portfolio mistake. The fourth check is liquidity and trading spread. High volume does not remove every risk, and low volume does not automatically make a fund unusable, but the investor should understand bid-ask spread, premium or discount, and execution risk. Long-term investors should avoid urgent orders in stressed markets when the underlying assets are less liquid. An ETF can diversify holdings while still having a market price that moves around net asset value. The fifth check is holdings overlap. Owning 3 ETFs does not always mean owning 3 independent exposures. The top holdings may repeat, sector weights may cluster, and geographic exposure may be narrower than expected. Overlap is not always wrong. Sometimes the investor deliberately wants more of a market segment. The problem is accidental concentration. The review asks what is repeated and whether the combined exposure still fits the risk budget. The sixth check is portfolio role. Each ETF should have a job: core market exposure, satellite theme, dividend income, bond defense, inflation hedge, cash parking, international diversification, or tactical risk. If a fund no longer has a clear job, it may simply be a leftover from a past story, a popular trend, or a short-term performance chase. A useful review asks, if I were building the portfolio today, would this ETF still earn its place? The seventh check is how the index rules shape risk. A dividend ETF may tilt toward financials, utilities, real estate, mature companies, or value sectors. A growth ETF may be concentrated in technology and long-duration earnings. A low volatility ETF can behave differently across market cycles. A bond ETF may carry duration, credit, currency, or reinvestment risk. The short fund name hides a detailed risk profile. The eighth check is distributions and taxes. Distribution frequency, source of income, withholding taxes, capital gains, reinvestment policy, and reporting rules can change the household cash flow result. A high distribution yield does not equal a high total return. A fund with low or no distribution may still compound value. The investor should connect distributions to total return and after-tax cash flow, not rank funds only by yield. The ninth check is currency and listing market. When an ETF holds overseas assets or is priced in another currency, return comes from both the underlying assets and currency movement. If future spending is mainly in the home currency, foreign currency exposure needs a reason and a limit. If future spending includes foreign currency needs, that exposure may serve a different role. The checklist should state the currency exposure clearly. The 10th check is position size. A good ETF does not deserve unlimited weight. Core broad market funds may be large, but they still interact with cash, bonds, insurance, mortgage debt, job income, and household spending. Narrow themes, leveraged funds, inverse funds, and concentrated sector funds need stricter limits and exit conditions. Without a size rule, an ETF can turn from a tool into a single bet. The 11th check is rebalancing. An annual ETF review is not a rule to add what went up and delete what went down. It compares actual weights with target weights and original rolls. If one market segment rises sharply, overlap and concentration may increase. If one market segment falls sharply, the portfolio may drift away from its risk design. Rebalancing is about restoring rolls, not predicting next year. The 12th check is available alternatives. Ask whether there is a lower cost fund with similar exposure, a clearer index, stronger liquidity, better tax fit, or a simpler portfolio structure that does the same job. This is not an invitation to trade constantly. It is a discipline that prevents a stale fund from staying in the portfolio only because nobody looked again. The 13th check is source material. A proper ETF review uses fund documents, fact sheets, holdings files, index methodology, fee disclosures, exchange data, and broker information. Social posts, recent performance tables, and fund rankings are not enough. ETFs are relatively transparent vehicles, and investors should use that transparency rather than memorizing only the ticker symbol. The 4-column ETF checklist is simple. Column 1 is tracking, index, exposure, weighting method, and tracking difference. Column 2 is cost, expense ratio, spread, tax, currency, and trading friction. Column 3 is overlap, top holdings, sector, region, asset class, and currency. Column 4 is roll, core, satellite, defense, income, inflation, or parking. If all 4 columns are clear, the ETF probably still has a place. If the review finds a problem, the answer does not have to be immediate selling. Possible actions include stopping new contributions, setting an observation period, lowering the weight through rebalancing, merging overlapping positions, replacing only when liquidity is good, or redefining the role. The goal is not constant trading. The goal is to avoid holding without a reason and replacing without a reason.